Hey, what's going on, guys? Rob from Feedbackwrench. Today I want to talk about, has anything changed about becoming an S Corp since the Tax Cuts and Jobs Act, the new GOP bill? And then I also want to talk about two things you want to consider that maybe would cause you not to become an S Corp. Really, this is all about understanding S Corps, and the big reason why this is important is because when it comes to proactive tax planning, there's three levers you end up pulling big time when you're a small business. When you're a bigger business with tons of assets, it's different. But the first one is understanding the S Corp. Should you become an S Corp? How do you manage your payroll and your dividend? That's a powerful tool. The second thing is using retirement plans and benefits, fringe benefits, regular retirement plans for super tax efficient transfer of wealth or to attract great talent. And then the third thing is real estate. Boy, real estate is a world of tax planning that's just fantastic. But because your S Corp is so important to tax planning, I want to talk about this. And just generally speaking, never become an S Corp, never file an S election, never go from being a sole prop to an S Corp. If you own property, never do that with a company that's just holding rental property, ever. Buy and hold property, you never want to do that with because that's not subject to self-employment tax. The other thing is make sure that you don't become an S Corp if you make net profits less than about $40,000. All you need to know is that when you become an S Corp, you need a payroll system to pay yourself. You have a new 1120S tax return. There's an additional cost there, and you want to make sure that your S Corp tax savings in your self-employment, because all an S Corp does is help you save self-employment taxes, not federal and state, but self-employment taxes. And you want to make sure that those savings would be greater than the cost of compliance. And now there's kind of two additional things that I'd layer onto there if you're a small business. Again, this isn't it can be for bigger businesses actually, but the new Tax Cut and Jobs Act has a new 20% write-off. Now there's phase outs. If you're married, I think it's in the $300,000. If you're single, it's $150,000 of income on your business, but it's for the pass-through income. So there's two sides to pass-through. You have sole proprietorship, that's your Schedule C pass-through income, and then in an S Corp, it's basically the dividend or the distribution, right? So what you need to ask yourself here is, that's a 20% write-off of the business income that basically goes against your federal tax rate, right? So if you're in a really high tax bracket, there could be an argument now where you need to weigh out whether that additional 20% and keeping your Schedule C income is bigger than what your dividend's going to be, because you always have to pay yourself a payroll. So you need to do this math to understand if this new big deduction that you're going to get on this pass-through income is going to provide better tax relief than what your S Corp or S election is going to. So there is a new little hiccup that you want to pay attention to, right? You need to do the math. You should probably talk to somebody, talk to a professional to start finding out, is by keeping my Schedule C bigger than your dividend on your S Corp, those are the only two that are subject to this 20% self-employment. And I'm keeping this simple. This is not complete. Talk to smarter CPAs, talk to people that understand how to walk your specific case through, right? This is not legal advice. But that's a new hiccup that you have. Now here's the second thing is remember that if you're a small home-based business and you have kids between the ages of about 7 and 18, you're going to hear more about this. Sandy Botkin has a book out there that's just phenomenal. I read his book every single year. It's a lot of the same stuff, but he updates it. And if you have kids, children are a great way for you can get them involved in your business. You can hire them for bona fide work, and if you hire them for bona fide work and you do this right, any child under the age of 18 and older than about 7, he's got some tax case that has said, as long as it's bona fide, this should work, above 7, that you don't have to pay self-employment taxes on that, but it's only if you're a regular sole proprietor. This is not if you incorporate. So when you incorporate, you no longer get this benefit of being able to hire your children. Now, if you have 3 or 4 kids and you want to have them come in, and if it's a Schedule E and you own property, boy, they can help with that. You can pay them. You don't pay self-employment taxes on it. Not only that, but if you pay them up to the standard deduction, which is $12,000, that first $12,000 for them, because they're still going to pay, they got to file a return now, is tax-free. You pay 0% tax, and then up to the next $9,500 in income is only a 10% tax. So when you're trying to decide whether or not you should become an S Corp, you need to ask yourself, is the new pass-through deduction valuable, A, and B, if I have children that I want to get involved in my business in a bona fide way, and you have to do some things really right, can the tax offset or the overall household benefit be greater than what I'm going to save in self-employment taxes by becoming an S Corp, especially when you net it out and you start looking at the cost of compliance. So there are some reasons why you might not want to become an S Corp now. There's an additional little hiccup in there. But again, if you have children, might be a big reason why not to. Now, if you hire your kids, here's some tips. First of all, have an attorney write up an actual employment agreement, right? Have an agreement with your child. Second of all, you got to pay them a reasonable salary according to their experience, work. It has to be reasonable. So you need to factor in the fact that they might be young and they might not be doing much. You should figure out what you would pay a normal person full-time and then take a portion of that. Don't push that. Don't be super aggressive with that. Be honest and full of integrity with everything you do. The third thing is pay them with a check. Have them open up a bank account. Always create a paper trail when you're doing it. And make sure that you're keeping great track of things, because the IRS will want to understand what's going on. Keep track of all their hours and what they did. Have them as part of their work. They could even do that. But get your kids involved in your small businesses, and remember, that's only if you're not a corporation. So C Corps and S Corps, that's not for you. That's only for pass-through. So if this is helpful, hey, save some taxes, partake in entrepreneurship, subscribe if that's helpful.